Hi there, James Good with another On the Money video update for Thursday, August the 30th, 2012. Now back in 2007, before I knew much of anything about so-called sophisticated indicators of risk appetite, like CDS spreads or CBOE put-call ratios or the like, I came up with this simple indicator to help me figure out when investors were either happy putting their money down or were busy taking it off the table. Without doing any back testing or anything, I just had an idea to set up a ratio of the semiconductor index, long time proven leading indicator of risk appetite, to the Japanese yen, which had for decades been a store for investor cash when seas got rough. The ratio rises when investors are feeling happy and want exposure to risk, and falls when they're feeling more uncertain or they're in pure panic. Now, amazingly enough, despite its clumsiness and its amateurishness, it seemed to work straight out of the box. It's pretty noisy in its raw form, but when you smooth it with moving averages, it gives clear signals and it shows its warning signs in plenty of time to do something before you get a major move in the S&P 500. Now, I think this risk aversion indicator may be telling us something important today, and I'll come to that in a moment, but to get to the right context, I want to show you its long-term record and how the indicator best works. Now here it is against the S&P 500 from 1995, when the semiconductor index was created, and the end of the dot-com bust. These are 21 and 55-day moving averages, and what you're looking for is non-confirmations between the S&P and the indicator, so that when stocks hit a new high or hit a new low, the indicator does not. Now, there were just five non-confirmations in this whole 8-year period, and that's where the indicator confirmed there was a divergence by crossing above or below its 55 EMA. 4 of those 5 led to a significant turnaround for stocks. You either got a correction, like in 1996 rather, bear market rally as in 2001, or you got a crash like 1998, or at the very, very top of the bull market like this in 2000. Now here it is between 1980 and 1995. Instead of the semiconductor index, which wasn't invented yet, I just used the NASDAQ composite, which in those days, remember, was perceived to be just as sexy and risky as the semis were in the dot-com era. 11 non-confirmations in this era, including this monster all the way into 1987, and every single one indicated there was a market correction of some degree coming up, whether it was up, as in these for example, or it was down, as in these. They're major or minor, every single one was a clue as to what was coming up. And finally, here is the picture since 2003. Across this period, 8 non-confirmations, and again, every one led to a reversal of some kind and some degree in the S&P, with this divergence, this positive divergence in 2008, being alarming only if you'd failed to sell at the sell signal here. By the way, I'm going to post these 3 charts on Twitter for those of you who'd like to study them more closely. But what's notable in the last year or so is the increasingly wide overall divergence since 2011, just as we saw in the lead up to the crash events of 87 and 98. Plus, we have a possible shorter term divergence setting up right here and now. Now this could prove to be more like 2005, a temporary blip over a few months. But given the outstanding record of this indicator over 32 years, 23 of 24 signals leading to a correction at the very least, you need to take seriously the possibility that this will end badly, and be ready if it does.